Welcome to the Deep Dive, your shortcut to being well-informed. We cut through the noise, whether it's dense research or, like today, a fast-paced earnings call, to get you the essential insights.
Exactly. We're here to help you extract those key nuggets of knowledge.
And today, we're doing a deep dive into Braze Inc.'s fiscal second quarter 2026 earnings call. This isn't just about the raw numbers, though.
Right. It's really about understanding how a key customer engagement platform is dealing with all the changes in AI and digital marketing.
Yeah, we want to explore what these updates really mean for Braze, where they stand competitively, and, what it means for you if you're tracking this space.
Okay, let's do it.
So let's kick things off with the headline results from Braze's Q2. And look, if you were hoping for good news, they definitely delivered.
Yeah, a significant beat on both top and bottom lines. The market definitely reacted positively after hours.
For sure. They reported a non-GAAP EPS of $0.15. Now, for anyone less familiar, non-GAAP basically strips out some one-off costs, gives a clearer operational picture.
And $0.15 versus a consensus estimate of just $0.03, well, that's a massive beat.
Huge. And on revenue, $180.1 million. That comfortably beat the $171.6 million expected, represents a strong 23.8% year-over-year growth.
Those are definitely attention-grabbing numbers. That's a pretty optimistic tone.
It does, but the real question is, what's driving it? What's behind these numbers?
Okay, let's unpack that. Let's dive a bit deeper into the financials and the strategy here.
Right. So first up in the financial breakdown, organic growth. Their core business revenue grew 22% to $177 million.
Yeah, and that's excluding the contribution from OfferFit, that recent acquisition, which was about $2.8 million in the quarter.
So that core growth is really solid, speaks volumes about the health of the underlying platform, even before you add in M&A.
And what's really compelling, I think, is the sustained profitability. This is now, 3 straight quarters of positive non-GAAP operating income?
Yep, $6 million there, and positive free cash flow, too, $3.5 million.
Plus 5 consecutive quarters of positive non-GAAP net income. I mean, in this environment, for a high-growth SaaS company, that's pretty remarkable.
It really is. A lot of companies are still prioritizing growth over profit. Braze seems to be showing real maturity here.
It suggests they've hit a scale where they can push for expansion, but also generate consistent income and cash. That points to, strong unit economics, disciplined management.
So how do they strike that balance then? Without hurting innovation or losing ground? Are they making big trade-offs?
I think it's less about trade-offs, actually, and more about smart execution and just a strong model. Their platform scales well. As customers use more, revenue goes up, but the cost to serve doesn't jump proportionally. They are optimizing costs, sure, but they're also investing heavily where it counts, like AI. So the growth feels intelligent, sustainable, not just growth at any cost.
That makes sense. Okay, what about gross margin? Non-GAAP came in at 69.3%. That's a little down year over year.
Yeah, slightly. Management pointed mainly to higher volumes of premium messaging, which have different cost structures. But they also mentioned cost optimization offsetting some of that.
So a constant balancing act, really.
Absolutely. And looking forward, the future revenue indicators look pretty robust. Their RPO remaining performance obligation is up to $862.2 million.
Right. RPO is the total contracted future revenue, basically, up 25% year over year.
Exactly. And the current RPO, the CRPO, that's the slice expected in the next 12 months, is $558.2 million. That's up 27% year over year.
So really strong visibility into future revenue.
Very strong. And OfferFit is already pulling its weight there too, adding $12 million to RPO and $10.5 million to CRPO. Not bad for a fresh acquisition.
Definitely not. Okay, let's talk customer expansion. They're growing the total count up to 2,422. That's 80 more since last quarter, 259 year over year.
That includes 17 net new customers just from OfferFit.
But the really interesting bit, I think, is the growth in large customers, those spending $500Ks or more in ARR.
That segment grew 27% year over year to 282 customers. And they now account for 62% of total ARR.
Why is that specific metric, the large customer growth, so important for a company like Braze?
Oh, it's absolutely critical in SaaS. Larger customers, generally, they churn less, they have higher lifetime value, and there's just more potential to expand within those accounts.
Right, they get more embedded.
Exactly, they're stickier. So strong growth there validates Braze's ability to handle complex enterprise-level needs. It shows they're winning in the most valuable part of the market, securing a more stable, high-quality revenue base for the future.
And that links straight into dollar-based net retention, DBNR. Overall, trailing 12-month DBNR was 108%. Solid.
And even stronger for those large customers, 111%.
Now, DBNR measures how much revenue grows from existing customers, factoring in upsells, but also churn. While the trailing number moderated a bit, management highlighted something interesting.
Yeah, the in-period DBNR, they said it stabilized and actually ticked up slightly from Q1 to Q2.
So why is that in-period number maybe a leading indicator we should watch?
Well, the trailing 12-month figure is backward-looking, right? It's an average of the past year. But the in-period change, especially that Q1 to Q2 tick-up, tells you about current momentum.
Ah, okay.
It suggests that maybe the rate existing customers are expanding is starting to improve again. It could hint at a potential re-acceleration, not just continued moderation. Maybe those new product initiatives are starting to land and drive expansion right now.
Definitely puts a more positive spin on future growth potential.
Okay, let's shift gears now to what's really driving Braze's future and maybe the future of customer engagement itself. AI and product strategy.
Yeah, this is huge. And that OfferFit acquisition, closed in early June, is a major piece here.
Right. Talk about the significance there.
Now, OfferFit isn't just, another feature. It's a reinforcement learning decision engine. Think of it like an AI that learns from every single interaction, what message, what channel, what time works best for each individual, and then autonomously optimizes the next step.
So it goes way beyond just basic personalization rules. Way beyond. It's about autonomous one-to-one optimization. And the fact it contributed $2.8 million revenue in just 2 months, and they expect $11-12 million for the full year. It just shows its immediate value and how fast Braze integrated it.
And they're building internally, too. They launched the Braze Model Context Protocol server, MCP server, in August.
Right. That's designed to connect large language models, LLMs, directly with Braze's first-party customer data.
The goal being faster time to value for marketers using AI, but what's the practical benefit? Why is connecting LLMs to Braze data so powerful?
It's immense, really. It lets that powerful generative AI tap into a brand-specific customer knowledge stored in Braze purchase history, preferences, past interactions.
So instead of generic AI content.
Exactly. You get highly personalized, contextually relevant content emails, push notifications, whatever they actually resonate, because it's grounded in real data about that customer. It makes the AI output much smarter and more relevant fast.
This feeds into their broader AI vision, which they call composable intelligence. Explain that a bit.
So the idea isn't just adding AI features. It's about giving marketers building blocks, configurable models, agents, operators, so they can become, as Braze puts it, strategic orchestrators of autonomous engagement systems.
Okay, strategic orchestrators. Sounds ambitious. How realistic is that for, say, the average enterprise marketer? Is there a big skills gap?
That's a fair point. It is ambitious. But Braze seems focused on abstracting the complexity. Marketers don't need to be data scientists. They're moving them from manually building campaigns to configuring and managing intelligent systems.
So the platform does the heavy lifting.
That's the goal. Ease of use is key. The hurdle might be more mindset shift than pure skill, but the platform's designed to make that leap manageable, not require everyone to suddenly become an AI expert.
And it seems to be working. They mentioned rapid adoption across their AI features.
Yeah, from data science tools to the Gen AI assistants. It suggests they're making sophisticated AI accessible, which definitely strengthens their competitive edge. AI isn't just hype for them, it's deeply integrated.
Why is AI so critical right now in this space, though?
Well, look at the broader trend. AI is disrupting things like search and SEO. Brands are realizing they can't just rely on third-party channels anymore. They need stronger first-party connections.
Ah, so platforms like Braze become essential for building those direct relationships, loyalty programs, owning the customer journey.
Precisely. It's both defensive and offensive for brands in this new AI era. You need to own that relationship and the data that fuels it.
And part of enabling that direct strategy is their flexible credits model, right? Helping drive adoption of premium channels like SMS, WhatsApp, especially internationally.
Yeah, that model is clever. Instead of fixed contracts per channel, customers buy a pool of credits they can use flexibly across SMS, RCS, WhatsApp, email, whatever.
So it gives customers freedom to experiment.
Exactly. Test new channels, new markets, without big upfront commitments. It de-risks trying things out. For Braze, it encourages using more of the platform, especially higher value channels. It's great for international markets where channel preferences really vary.
Makes sense. Okay, let's talk management outlook. There was a real sense of confidence on the call.
Definitely. They highlighted improved sales execution, historically high win rates against competitors, better pipeline qualification.
And smooth integration of Ed McDonald leading the go-to-market side. What do these operational points tell us?
They tell us the commercial engine is running well. High win rates mean the product's resonating and the sales team is effective. Better qualification means more efficiency. A smooth leadership transition means stability. It all points to a mature, effective operation ready to capture market share.
And they are capturing it, seemingly. They mentioned displacing legacy marketing clouds and point solutions, citing wins like Little Caesars, Sweetgreen, Wix.
Yeah, that enterprise replacement cycle they talked about. Legacy clouds are often clunky, hard to integrate, lack real-time data, lack native AI. They're just not built for today's needs.
Like an old mansion versus a smart home.
Kinda, yeah. Braze offers agility, better performance, often lower total cost of ownership. These big wins show that more companies are realizing their old systems just can't keep up. It's a significant tailwind for Braze.
And that confidence flows right into the raised guidance. For Q3, revenue projected $183.5 to $184.5 million. Non-GAAP EPS 0.06 to 0.6 to 7 cents.
And that Q3 operating income guidance includes costs for their big Forge conference, so they're investing while guiding up.
Right. And for the full year, revenue raised to $720 million. That's about 21% growth year over year at the midpoint. Very strong.
Non-GAAP EPS guidance also up to $0.41 or 42 cents. And importantly, non-GAAP operating income guidance raised significantly to $25.5 million.
That implies a 3.5% non-GAAP operating margin, which is a big jump, right? A 350 basis point improvement over last year.
That 350 basis point improvement is huge. For a company growing over 20%, boosting margins that much in 1 year shows serious scale efficiencies and cost discipline.
It's not just getting profitable, it's improving the quality of that profitability quickly.
Exactly. It signals investments are paying off, and they can drive both top-line growth and bottom-line expansion at the same time. Really strong signal.
Now, they did acknowledge the demand environment is still, quote, challenging, but they sounded optimistic, citing solid bookings and saying global issues weren't really hurting deal cycles much.
Which suggests that even if the macro isn't helping, their specific execution and product strength are winning out.
Yeah, it implies their solution is seen as mission critical, not just discretionary spend.
Right. Brands feel they need this kind of sophisticated, AI-powered engagement to compete, even when budgets might be tighter elsewhere. It provides a nice defensive quality.
Okay, so pulling it all together, what does this mean for you, the listener? Braze is showing a clear path to durable profitability while making smart, significant bets on AI innovation.
Yeah, the strong beats, the raised guidance, it definitely eases near-term worries about execution. They seem to be managing well in a tricky software market. They're not just riding the AI wave, they're helping shape it for customer engagement.
So key things to watch going forward.
Definitely keep an eye on that DBNR stabilization, especially for large customers. See if it starts to properly reaccelerate. That's a big indicator.
And the new AI stuff.
Yeah, watch adoption rates and cross-sell metrics for OfferFit, the MCP server. Are customers actually using these tools? Is it translating into bigger deals, faster growth? That's crucial.
And near-term catalysts. The Forge conference is coming up fast. End of September, early October in Vegas.
Right. Expect big announcements there on the AI, vision, and product roadmap. Could be a real momentum driver. They're holding an investor reception too, so lots of focus will be on that event.
Okay, time for our This Is Not Financial Advice segment, and we mean it. Purely informational for entertainment. Not advice. Do your own research.
Always. Okay, outrageous but plausible idea number one, the AI challenger play.
All right.
Given Braze's aggressive AI moves, OfferFit, MCP server you could consider pair trade. Long Braze, BRZE. Short, a legacy marketing cloud provider.
The thinking being.
The thinking is Braze's composable intelligence and first-party data focus position it perfectly to win that enterprise replacement cycle they mentioned. They disrupt the older, slower players.
So you're betting on Braze's tech advantage while hedging broader market risk.
Exactly. Long the innovator, short the incumbent with that specific AI angle.
Okay. Plausible, if definitely requires conviction. Idea number two.
More aggressive, short term. The Forge event catalyst.
Betting on the conference itself.
Pretty much. With Forge coming up end of September, you could look at buying out-of-the-money call options on BRZE, maybe expiring late October, early November.
The bet being that big positive announcements and customer buzz from the conference drive the stock higher, building on this earnings momentum.
That's the idea. Higher risk, potentially higher reward, tied directly to that event. Again, just an illustrative idea, not a recommendation.
Understood. Okay, so let's recap this deep dive. Braze delivered a really strong Q2. Robust organic growth, clear AI commitment, impressive efficiency gains, and a solid path to profitability.
They're navigating a complex market really effectively, seems like, focusing on the tech and the customer experience.
So, final thought for you to take away.
I'd say this. In this era of fast-moving AI, customer engagement is really where brand loyalty will be won or lost. Think about how deeply embedded AI personalization and first-party data need to be for companies to really thrive going forward.
Yeah.
Are your own investment ideas, maybe even your own business strategies, really aligned with that fundamental shift towards autonomous, intelligent customer engagement? It's definitely something worth mulling over.
Excellent point to end on. And remember, here at the Deep Dive, we provide insight, not investment recommendations. Please, always do your own thorough due diligence.
Absolutely.
Thanks so much for tuning in, and we look forward to having you join us for our next Deep Dive.